Valens Research, Uniform Financial Analytics.
What you see here is the Valence Credit Weekly Insight Report. On this report each week, we highlight a couple of key things. One, we take you through what are the most compelling mispricings we're seeing from a few different perspectives. We look at what is the credit versus equity market mispricing we're seeing, right? Where are we seeing that the equity markets are overly bullish while the credit markets are overly bearish? Meaning, if you have the opportunity to just arbitrage between the two, you have a riskless trade in essence, including if it's vice versa, if the equity markets are too negative and the credit markets are too positive. Next, we highlight where is it that Moody's, S&P, and Fitch are just flat wrong on a name. Where is it that they have a massive dislocation between what the real credit risk of the name is, like say AMD, where Moody's rating is B2, while Valens rating is an IG3+, right? Because the fact that we're saying the rating spread is so that the fundamentals of the business have gotten so much better, this is not a company that's ripe for bankruptcy. Then we go through credit market mispricing opportunities. First, we look at where are CDS markets mispricing names, where are we seeing that the CDS markets are either much more bullish or much more bearish than they should be relative to ICDS, and also what are the most compelling bond mispricings we're seeing in terms of where the I yield to worst, our intrinsic yield to worst, fair value yield to worst for the bonds is significantly higher or lower than the yield to worst the bond is currently trading at. We give you that just every single week. On top of that, we actually go through the names that we've written up in a given week. We write generally 4 to 6 Valence credit reports each week where we're going deeply into one name and analyzing what are we seeing for the fundamentals for this name and for the credit that make it look mispriced for us, either from a ratings or from a bond or from a CDS perspective. What we do is we actually let you go deep into understanding for the 2 to 3 names that we think were the most compelling this week, what are we seeing for the names? So we actually give you a breakdown, for instance, for AK Steel, what is the fundamental insight that we're seeing that drives us to still think that AK Steel is mispriced right now? We do the same thing for Constellium, which is another company on the material space. And we also highlight for Hertz why we think Hertz is mispriced in terms of thinking that the bonds actually, there's some bonds that should be bought and some bonds that should be sold. And we also highlight for the other 2 to 3 names that we've written up that we don't necessarily have trades on or think are that compelling, what were the insights that we saw in them, but we don't spend as deeply. The next thing that we do is for those investors that are more interested in using uniform accounting from a quantitative perspective than using our research, to just be able to take what we're seeing from a mispricing from a credit market perspective without any fundamental research, just the uniform accounting overlay that we're doing on the company's financials to identify where we're seeing mispricings. To just take that, we give you the quantitative list of which names we're seeing that have big CDS to ICDS or bond spread to worst to ICDS dislocations, and also names where we're seeing big equity to credit market dislocations with no fundamental overlay being done. We also give you a macro perspective of what's going on in the credit markets. So not just what are we seeing from a individual credit perspective, but where are we seeing credit markets overall being mispriced in terms of either the high yield market, the investment grade market, or the crossover market, right, which is between high yield and investment grade. We're saying either overarchingly this market is mispriced and we should actually be focused on this market for idea generation, or overarchingly, this market is fairly valued and really we should just be looking for alpha within the market as opposed to overweighting or underweighting a market. What we're seeing right now is a market where for high yield and investment grade, high yield and investment grade markets both look actually pretty fairly valued right now in terms of where the market is from a CDS perspective versus our intrinsic CDS for those two markets. On the other hand, while crossover CDS is basically trading midway between investment grade and high yield, the fundamentals say it really should be trading far closer to investment grade. And so this is an example of an interesting one where we're seeing that really crossover names are where we should be overweighting portfolios if we're looking to overweight portfolios right now. And we cover this on a weekly basis. The last thing we give you on the newsletter is a breakdown of all of the credit ratings that we have for the largest 600 names in the US and internationally that have liquid markets in terms of their CDS and their bonds in particular. So we can give you a context of what names are we seeing that actually have some mispricings in terms of the ratings, so you can identify if you're just looking at it purely from a ratings perspective and want to know, hey, I'm thinking about buying this bond. Is it really investment grade? Or, hey, Moody's and S&P and Fitch are telling me this bond is a high yield bond, but I actually think the fundamentals are better. Is that true, and should I be buying it or not? This gives you context to be able to do that from the newsletter, and you get this each week.
Valens Research, the world's leading source for uniform financial analytics.